Hello, chart watchers, and welcome to this Tuesday, June 5th Market Watchers live show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the market trying to give back some of its gains from yesterday. The Dow Jones Industrial Average currently down 73 points. The S&P 500 down 4. The NASDAQ up 7, about 7.5 points, extending its recent gains and moving or keeping that move above the 7,600 level so far. Russell 2000 also beginning to show a little bit of relative strength. Again, it is up 2 points today. 10-year Treasury yield moving down about 3 basis points back to 2.91%. Volatility falling, but looks like it's trying maybe to put in a little short-term reversal. Nike breaking out. I did something a little different here. These next 6 stocks were just stocks that look kind of interesting to me on the charts for one reason or another. But Nike making a breakout yesterday, holding that breakout today. Royal Caribbean gapped down earlier today. It was in a bear flag, and it is making a big breakdown, volume picking up. Vertex Pharmaceuticals, VRTX, this one taking out those early May lows and doing so with a huge red candle. We either need to see a big reversal today or we've got a breakdown on Vertex. Kohl's continuing to make a big move to the upside. A couple of not really nice candles last 2 days. This takes out, you can't really see it on this 2-month chart, but this takes out some pretty key overhead resistance after a period of consolidation on Kohl's. Akamai Technology, big breakout above this double top, looking to close above 78. Volume thus far confirming this move to the upside. JD.com having a pretty nice day today, up 2%, challenging gap resistance and the reaction high that we saw back in the first week of May, but the weekly chart not looking so great. I'll take a look at that one in just a bit. But first, let me bring in my co-host, Erin. Happy Tuesday, Erin.
Yes, happy Tuesday to you as well, Tom. How's your weather out there? I'm a little bit cloudy here.
Oh, I don't want to talk about weather. I want to talk about sports. You're going to try and sneak right past Cap's third win.
Yeah, I know, right?
Playoffs.
I was waiting to see if you'd catch that.
Yeah, I was not going to let this one go. I know everyone's out there. All right, let's move on. No more Caps talk, but you got one more game. You got to deal with me for one more win.
Yes, hopefully it'll come sooner rather than later. I think our viewers are probably hoping for that too.
We have some hockey fans out there. I know we got a lot of friends in the north.
That's true.
Canadians love hockey. They love their hockey, and they got a feel for me. Too bad Grayson isn't on here. Grayson's a Toronto fan, Maple Leafs fan, and they've certainly had their problems over the years. I could get a little simple.
Well, Greg Schnell and I have a great time because he's a Calgary Flames guy. And of course, we're in the same division in the Pacific. And oh, goodness, we beat the heck out of them. Yep. They come to our house, the Ducks, and they almost always lose. They've only won one out of the last 27 games in our arena. So,
well, I promise to take off tomorrow from hockey because the Caps don't play again until Thursday night. So I won't bring it up again until Thursday. How's that?
All right. Sounds good. We'll have to get ourselves reacquainted with baseball, I think. All right. So this week we've got, today I'm doing my workshop, but tomorrow we have Charlie Kirkpatrick. Bruce Fraser is going to be in on Thursday. And Friday we have Chip Anderson coming in to do the Everything Stock Charts segment. Today, though, I will be starting it off with an introduction to market breadth. 10 and 10 to 1. We're going to look at Danaher Corp, DHR. Get those 10 and 10 symbols in early for me, please, because I won't be able to write them down much during my presentation, and we go right into the 10 and 10 after that. And finally, we're going to finish with a segment called Turning Point, and I'll let Tom discuss that when he gets to it at the end of the show. So let's go ahead and get started with the technical news and headlines. Tom, are you ready?
I'm ready. 10-year Treasury yield today down 3 basis points. We had a couple of economic reports out earlier this morning, 9:45 a.m. Eastern Standard Time. The May PMI Services Index came in better than expected, 56.8. Market looking for 55.7. And then the May ISM Non-Manufacturing Index came in at 10 a.m., 58.6 versus 58. And you can see we have pulled back a little bit. From a technical perspective, this was an interesting area that we got back to yesterday when we hit 2.94%. Because if you remember, 294, 295 was a big top back in February. We got back to almost 294 in the middle of March. We finally broke out above that level. And notice these pullbacks, we held right around 293, 294. and then we just lost it again, but we did hold the prior low. So technically, I think we're just in a short-term range here where we need to get back up above 295 to clear that resistance, also to take out the 20-day moving average. And to the downside, we've got still that recent low down around 276 and the early April low around 272, 273 as key levels to watch on the 10-year Treasury yield. I did look intraday today when the economic reports were coming out. And if you look at the 10-minute, 5-day 10-minute chart, you can see that the 10-year Treasury yield did move lower at the open. We rallied all the way back up, and we got to about 10 o'clock, just after 10 o'clock, after the news came out, the economic news that I talked about. It was just a little bit of a beat, wasn't anything huge. But once that news came out, we did see the yield turn back down and money rotate into bonds. I just think we're in this sideways consolidation. I'm going to say that to the downside in the near term, maybe 288 is a level to watch. That's that low that we saw back at the end of Friday. And then to the upside, 294, as I mentioned earlier. So we're in the pretty narrow range. Let's see which way we break out of this as we move forward. A couple of stocks in the news. Starbucks, always like to talk about Starbucks. And you can see that Starbucks currently is down, but it is trying to hold on to some key support around the 55 to 55 and a half level. Each time we've moved down into this area over the past few months, we have held and then turned around and moved back up towards 60. So until that changes, that's exactly what I would look for. Volume is heavy today. Howard Schultz announced he's stepping down from his role as executive chairman, and Myron Ullman will be the next chair of the board of directors at Starbucks. So a little bit of a move to the downside, but we are off our worst levels. Volume is heavy, so let's see where we close today on Starbucks. Next up, Twitter. Twitter had some good news today. It's being added to the S&P 500, and as a result, another gap up. Twitter's been very strong, along with technology. This whole bounce in the market that we've seen here in recent weeks, big move on Twitter, taking out the March high and doing so with increasing volume. So looking good here with Twitter on the charts. Dish, this is a crazy reaction. The chairman disclosed he purchased 100,000 shares of Dish. We got a little bit of gap up. Now the stock's coming back down, a black candle, meaning that we're now near the low of the day. We're below the open, but we still have a gain. That's why it is a black-filled candle as opposed to a red-filled candle. It is up for the day, but it's down from the open. So the black candle, the significance is that you still do hold on to a gain, but you are down from where we were at the open. Not great reaction. I will say, though, that we've got a nice positive divergence here on lower closes in terms of price, and see how we've been failing to get through this 20-day moving average for months, essentially through or since the beginning of 2018. I think now with this news pulling back, this could be an opportunity here in the short term for Dish. I don't know that I'd look for it to go screaming higher, but I wouldn't be shocked with a positive divergence in play and some good news coming out. Maybe we get through the 20-day, make a run for the 50. $34 would not be out of the question to me. The stock trading $29.48. Recent lows you could use as a stop. This looks somewhat interesting. NKTR, Nectar. Wow, what a drop yesterday. And I had this as one of my Monday setups not that long ago. Thankfully, it wasn't when this news came out. I do want to say, and I've talked about this a lot, anytime you're in any biotech or pharma, especially the smaller ones that have just a few products, you can wake up to some bad news. And it's not usually earnings related. It's normally some sort of a test that's been going on. In terms of Nectar, there was disappointing trial results from a cancer drug that they've been in collaboration with Bristol Myers on. And check out the stock. It was $90. It fell all the way back down to 53 at yesterday's close, which represented, I think, about a 41% drop. And I read somewhere it was the biggest drop in one day on any S&P 500 company in the last 5 years. So this was a big move to the downside. Again, not earnings related, but test results related for a biotech. It's always, I tend to, well, I'm not going to say that will buy individual biotechs from time to time. But I think for those of you who are really interested in trying to minimize risk, I think some of the biotech ETFs or the pharma ETFs are the way to go. So something like the IBB for the bios, or maybe I think it's the PPH for the pharmas. me just pull that up and make sure I'm giving you the right. Yeah, the pharmaceutical ETF, PPH. This is one way to at least diversify within the group without having to take on the kind of risk that you take on when you're in individual stocks like Nectar Therapeutics. Stock is bouncing back a little bit today, but that is probably very little comfort to those who held from 90 down to 53 yesterday. A few stocks out with the earnings today. Let's start with I don't know if this is GIII or G3 Apparel, but big gap up, heavy volume. They came out, they beat top line, beat bottom line. They were raising. I saw this being raised, that being raised. Everything looks good. Folks jumping in 50 wanted to open. Now it's I really like the stock. I love this gap up and the big volume, but I'm going to hold off and see how it trades here. Maybe get it in a few days or maybe even a couple weeks. Maybe it'll work its way back down to gap support, get close to that 20-day moving average that's coming up pretty rapidly. And then I think the reward to risk would be much better. So that was G3. Another stock came out with great results, raised guidance, Navistar. And Navistar had closed yesterday around 38.5, opened today at 40.16, looked like it was going to break out and then reversed. And now it's down $1.03, down to 2.67%. And then finally, another one that came out pretty solid results, HD Supply, opened at 42.5, got up to 44, and now it's back near the low of the day. Now, just keep in mind, all three of these companies had really nice results. I don't know if HDS raised guidance. I know the other two did, and you can see how far these stocks are trading off their earlier highs. Now I'm going to give you a couple that were going the other way that reported bad results, and check these candles out. Francesca's came out. They missed everything. I couldn't even tell. I think they missed their earnings. I think they missed their revenues. They lowered their guidance. Stock gaps down to $5.38 on the open, and it is now $1.09 higher from there. It's up 20% since the open. So if you notice, the ones that came out with great news gapped up and then sold off. Fran went the other way, gapped down and then was accumulated. And take a look at the last one, ASNA, another one that gapped down, poor results. It was trading at about 365. It opened today at 340 and it went up as high as 409. So this one gaps down and reverses. One thing you have to understand about the market, especially if you trade it in the short term, is that a lot of times when you get the news and you get that initial reaction, one way or the other, the worst thing in the world is to chase, because you've got market makers on the other side and their job is to provide liquidity. So in the case of ASNA, when the bad news comes out and everybody wants to sell it on the bad news, market makers are on the other side of that trade buying. That is why many times you will see in the short term anyway, a reversal in that particular stock. So keep that in mind. All five of these stocks, I think, are a pretty good testament, excuse me, to the fact that you don't want to chase that knee-jerk reaction after news comes out. All right, a couple more stocks here. Let's talk about upgrades and downgrades. First, an upgrade, PCAR, PCAR. I want to say this one was just upgraded or downgraded a couple of days ago. I think might have been with this heavy volume here on the move down. It's been downtrending for a while. You still got some pretty good support here between, say, 60 and 62. We're currently trading at 64. With the upgrade, we did get a little bit of a pop earlier today, but the downtrend still remains in play. I would view PACCAR as trading in a range right now between 60 to the downside and about 66, 67 top side. That May 22nd high is one that I would watch pretty closely. All right, downgrades. Let's see here. OKTA. All right, we got a downgrade, but this stock's been going up on very heavy volume. It's probably, I didn't see why they downgraded. My guess is it's probably valuation, because the stock just in the last month has gone from 42.5 up to 58. That's what, about a 40% move in 1 month. So you got a little bit of a pullback based on the downgrade. I doubt it will stick. I would look for the rising 20-day moving average here to serve as a pretty good support area. First Solar, the renewable energy stocks had a big move to the downside yesterday. I'd be looking on First Solar here for some sort of reversing candle. There has been a lot of volume to the downside, so it could just simply be a breakdown and we're going to go lower. But if we get a reversal on this kind of volume, we've already traded 4.8 million shares today. It looks like it's going to be the heaviest volume day, perhaps, of 2018. And so if we could get a reversal, close near the high of the day after coming down and testing this February low, maybe we're putting in a bottom. It's too early to make that call. Let's see how it trades this afternoon. Ulta, ULTA. This is a company that I know very well. My daughter loved shopping there growing up. And I think I was personally responsible for most of the advance. If we go back many years on the stock, monthly, 15 years. Yeah, this whole period starting back in about 2009, I think I probably accounted for about half the sales in Ulta. But anyway, the long-term chart here I think looks pretty good. The problem with Ulta was from a longer-term perspective, looking at this monthly chart, we had higher prices and a lower monthly PPO. That sent us down really all the way back down to the PPO center line on a monthly basis, and also the 50-month moving average. And now we've started to move back up again. I think the long-term chart here on Ulta is pretty nice. It had moved up. Got to give it a little bit of room to the downside. Clearly, if it were to go back down and take out those lows around 190, 200, that would bother me, but I don't believe that's going to happen. I think that Ulta is going to continue to resume its push to the upside. So even with today's downgrade, I think it's hanging in there pretty well. It is down $5, 2%, but off of a move to the upside with a negative divergence on the daily chart, higher prices, lower PPO. We did go down and test that 235 area, the 50-day moving average, before bouncing yesterday. I think we're in a range. I think this 235 to 260 area will probably contain the price action on Ulta in the near term. Let's see which way it breaks. My guess is it's going to be to the upside. And one more, let's take a look at Take-Two Interactive, TTWO. I think this is a nice looking chart. A beautiful move up. It looks like, let me go to a weekly chart and see if we have a longer term uptrend. We do. I think this is a beautiful uptrend. Look at the negative divergence. See the higher price, the lower weekly PPO. We went all the way back down to the center line, went back to that 50-period moving average, now starting to go up again. But what I really like is after this uptrend, bearish long-term action, we just needed to unwind that negative divergence. And I think we've done that with an inverse head and shoulder pattern. So we came down left shoulder, went back up, put in the left side of the neckline, the lower low prints the head, right side of the neckline, pulled back to the rising 20-week moving average. I think that's the shoulder. I think Take-Two looks really strong, and a breakout, if we go back to the daily chart, I think if we can get back up and clear 117.50 with volume confirming, and so you want to see a spike on the volume bar down here. But if you get a close above 117.50, that measures about 25 points based on looking at the neckline all the way down to the bottom of that inverse head. 25 points, you tack that on, and we'd be looking at 142.50. Stock currently trading at 113.28. That's a nice potential upside. If you're playing this and you're playing this as a right shoulder here, you could maybe keep a pretty tight stop where you're only giving up 3, 4, 5 points to the downside while you've got maybe 30 points to the upside. Really nice reward to risk trade here. So Erin and I talk a lot about these upgrades and downgrades, sometimes presenting some opportunities. I think in the case of this downgrade on Take-Two, I think it's an opportunity maybe in a more bullish pattern to eventually see a breakout above neckline resistance and make a move up into the 140s based on measurement. Okay, I know Erin would like to get into the breadth indicators, give you a little introduction there. So I'm going to turn it over to Erin. Take it away, Erin.
All right, and here I am. Let's go ahead and get started. This is pretty much a basic introduction for you on what breadth is and pretty much the most popular indicators. I'm not going to go through, there are certainly some advanced versions of these indicators, but I prefer to give you the quick and dirty. Here's what the typical ones are and how do we normally look at them as far as analysis. I did get most of my information from John Murphy's book and also Charlie Kirkpatrick's book. He will be on the show tomorrow, so that's pretty exciting. And so you can get more information here by going in to look at those books, and you can look up, of course, the market breadth. So what are we going to cover today? I'm going to give you, of course, the what is it. We're going to do a divergence review, looking at divergences, because typically when you analyze market breadth, you're going to be looking for divergences. And so I'm going to give you a little bit of a refresher from my workshop that I had on divergences and convergences. Then we'll look at the advanced decline line, advanced decline volume. McClellan oscillator is one of the very, that's my favorite. ARMS indexed, or the TRIN, we'll look at that and how you can use that. And then of course, new highs, new lows, and then you can use the percent of stocks above or below their EMAs as another way to look at market breadth. So what is market breadth? Well, it is actually, it's a measure of the advancing issues, the declining issues, and the unchanged issues. So, you know, every day we have a number of stocks that finished, they advanced for the day, or they declined for the day, or they just were simply unchanged. And we count that up. That's what breadth is about. So we're looking at various versions of advancing and declining issues, or advancing and declining volume, because you can use this also. You can use advancing and declining volume in the same way you use an advanced decline line.
Hey, Erin.
Yes.
I'm sorry to interrupt. I didn't know if you had moved on to another slide, but I'm still showing that first slide.
Oh, okay. Thank you.
Maybe it's not in the play.
Yeah, it's weird. It's telling me to resume the share, and it won't let me get in here. Let's try. You know, we do our very best here. So you're only seeing the intro right now?
Yeah.
Okay, thank you. Well, we'll get a really quick redo here once I can get this share. All righty.
And maybe sharing desktop. Yeah, there you go.
There we go. So let's try that one more time. All right, there are the references. And so we're going to look at what breadth is. We'll go through those divergences, and here are the various indicators that I plan on covering as well. So what is breadth? As I was saying, we're looking at the measures of the advances versus the declines versus the unchanged issues or stocks. But you can also use the advancing volume or the declining volume as well when you're doing advanced decline studies. Advanced decline studies, or breadth studies, measure internal strength. And the way we do that is we track whether the stocks are gaining or losing based on the price. So if we're looking at, if the market is going strongly upward, we need to see participation, meaning we want to see breadth being very positive. We want to see more advances versus declines, which you generally will, of course, on an up day. But you want to see those either the climactic moves in breadth, or just simply the moves that match as far as when you're looking at divergences, that everything's going in the same direction. Speaking of divergences, let's take a quick look at how we look for divergences, because you're going to use this typically to do your analysis when you're looking at market breadth indicators. So the bullish divergence, and as I told people during my divergence workshop, which I think you could find on YouTube, you start with the indicator, and then we're looking at rising bottoms or declining tops, because remember, there really isn't a such thing as a declining bottoms line or a rising tops line. They don't help you with your analysis. So start with the indicator and look for rising bottoms or declining tops. So a bullish divergence is you have rising bottoms, and that is consistent here with a declining bottoms on price. This is a positive divergence. If you see, for example, consider this. If this is a momentum indicator, when the negative momentum starts to happen, it pulls back, but it doesn't move all the way down to that previous low or further. So momentum on the positive side is being conserved, but we're seeing price pull way back into oversold territory. So when you match this as a divergence, it's bullish divergence. A bearish divergence, like I said, start with the indicator if you're looking at declining tops, and then you compare that and you get higher highs on price, that's bearish. So you, for example, if this were a momentum indicator, as I was saying before, if you're getting lower tops on momentum, you know that overall the trend, the momentum trend is declining. So you want to see, so if you see price rising during this momentum that's slowly starting to trend lower, that's a bearish divergence. So what are the oscillators and indicators that we use to measure breadth? Well, of course, there is a simple advanced decline line, and it's basically a running total of the advances minus the declines. And it's plotted on a line. There's also a volume version where you use the advancing volume minus the declining volume, and you can also chart that for looking for divergences. Charlie Kirkpatrick does send one of the things he was talking about when he was writing about the advanced decline line is he said that it does tend to give greater weight to the near-term data. And so a lot of people would prefer using the advanced decline ratio. The advanced decline ratio is number of advances divided by the number of declines. And again, plot that on a chart in a line form. But typically what you're going to see, and also with most of the breadth indicators, you're going to see some sort of smoothing. So you don't have all of that erratic data. It's helpful to use a moving average. And in terms of the advanced decline ratio, typically you're going to take a 10-day EMA of the number of advances and divide that by the 10-day EMA of the number of declines. And that's going to give you the ratio. Now, when we go and look on the website, which I'm going to take you to right now, so that I can give you some views of these. This is actually in the Essential Breadth Indicators. This is part of the StockCharts Essentials chart pack, and I'll be showing you how to download that at the end of this particular presentation so that you can get easy access to all of these. So as you can see, we've got the advanced decline lines. We're going to go through some of these other indicators, but let's start with the simple advanced decline line. And here we go. So this is the net advances minus the, it's the net advanced decline. So basically you're taking, again, remember you're minusing the declines from the number of advances, and then you're plotting this on a line. And so this is what we're looking at. This is a 50-day EMA of those advances and declines. Like I said, typically what you're looking for are divergences, either confirmations. For example, in this particular case, when we look at the bottoms on the advanced decline line, they're rising, but on price, they are rising as well. So that would be a confirmation. If you're looking at these declining tops, and we have declining tops, now you're looking at a bearish confirmation. Let's see if we can find any divergences on here. We haven't had too many as of late. Here's one right here. So let's go ahead and annotate this very quickly. Make it really thick. And so you can see, there we go. Those are the bottoms there that are rising. And we're going to look over here at, there we go. Actually, I did that wrong because I need to start with the indicator. Whoops, sorry about that. But basically, these are the kind of divergences you're looking for. So you can see within price, you've got rising bottoms as far as the indicator is concerned, and you have these declining bottoms on price. So that's considered a bullish divergence. And so the expectation after that sort of a divergence is for upside movement. And we did see that in this case. So that's a good example there for you of a bullish or positive divergence. I can see, let's see, declining tops. We need to find some declining tops and see if we can match them. Declining tops. And over here, rising. So that would be a bearish divergence. And in this case, you did end up seeing a little bit of a decline here, but you know, during this parabolic rally we had with the S&P, we didn't see much come out of that decline. And in most of the cases I found with the indicators during that particular advance, you would end up getting a little bit of a decline or some consolidation rather than getting the big decline you would normally expect off of a convergence or a divergence. All right, so that was the advanced decline line. So let's go back. Let's see. Yeah, and this is also, you know, when you're using the ratio, and I did notice on StockCharts, I didn't find any pre-made charts that actually use the advanced decline ratio, but it is something that we do see, and you do get a buy signal if this ratio it becomes greater than 1.91. But as you're going to see, the ARMS index is going to be very similar to this, so you can use that. The McClellan oscillator is probably one of the most famous breadth indicators out there, right following the advanced decline lines. And we did have Tom McClellan on the show. And again, you can go back to StockCharts TV on YouTube, and you should be able to find Tom McClellan's presentation from our Market Watchers Live. And the McClellan oscillator is basically determined. You take the 19-day EMA of the daily advances divided by declines. So this would be your ratio. And now you're subtracting that from the 39-day EMA of those daily net advances and declines. So this gives you an opportunity to look at, you know, where the thrust is going. And then the summation index is also used. This is a longer term version of the McClellan oscillator because it just takes the cumulative total of those values. So let's go ahead and take a real quick peek over here at the McClellan oscillator. And we do have versions for the NASDAQ and the S&P. So here is the McClellan summation index. Let's go to, actually, I'm going to show you one of my indicators from Decision Point, and I'm going to show you how to do this as well to download these chart packs. Alrighty, so the one I always use is the S&P 500, so I might even have some, yes, and it's even the right size for everything here. Okay. So here's the S&P 500 by price. These are the McClellan oscillator values. So you can see the oscillator itself is pretty intense. You get a lot of movement back and forth, kind of twitchy, especially when you're looking at a long-term chart like we're looking at now. And then there's the summation index, and it basically is taking the McClellan oscillator values. If they're negative, it subtracts it from the running total, and if it's a positive value, you add it to the total for the summation index. And here is that 19 and 39-day EMAs of that advanced decline ratio. And here you go. So you can see that when the 19-day EMA is above the 39-day EMA, you're going to make that subtraction. You're going to get a positive number. And in this case, roughly 100 minus 80 is about 20. And there you go. So it's about 20. And then you add that 20 value to the cumulative, the cumulative summation index. And you can see if you add 20 to 625, you're going to end up right about 645. And there's your summation index value for that day. So let's go ahead and look at one that's a little less busy. So I'm going to take this. I want to move the period to 2 years. Let's not get, it'll be a little easier to see all of them. Here we go. So there you go, the twitches and then the actual summation index. And again, this is something you can look for divergences and convergences. Also looking for values, tops and bottoms, overbought and oversold lows on the index. So those are other ways you can look at these. It is an oscillator, so it is an overbought, oversold indicator, and you can use that. Next up is the ARMS index, or the TRIN. And this, as John Murphy says, is a ratio of a ratio. So the ARMS index, also known as the TRIN, you take the number of advances divided by the number of declines, or your advance decline ratio, and you divide it by the advancing volume divided by the declining volume. So this is your advance decline volume ratio. So you're taking the advance decline ratio and dividing it by the advance decline volume ratio. And that's how you come up with the TRIN. You can use this also in conjunction with tick data, which of course measures, minute by minute, how many stocks are trading on an uptick or rising, advancing, and how many are trading on a downtick or declining. So you can use that minute by minute tick data and use the TRIN as an advanced decline line, and then make some comparisons that way. So let's go ahead and we'll look at the ARMS index. All right. Oops, not that one. Now, I typically don't use this indicator that much, but some of the things to think about when you're looking at it. Let's see, I want to get to, yes, this is the chart I want. This is the one I do use off and on. This would be part of my monthly checklist study. If I see anything interesting, that's when I can bring it to your attention. And the main thing is when you're calculating the TRIN, this is of course the New York Stock Exchange price. The TRIN is best used, I find, when you're looking for these spikes. And I have the level of the 2.0 on here for the TRIN because typically this was one of the tricks I learned from my dad and one of his analysis cohorts, Nicholas Profit, rest his soul. He said that if you get the TRIN spiking above 2 on a day, that the next day you're going to see a rally. And it does hold true a lot of the time. So this is something that you can use. For example, let's go ahead and annotate so we can see right in particular very quickly. So let's take one of these. So here was the tick down. And so that was where we closed. And the next day we ended up. Let's look at this one. Here's where we got the value. And the next day we did get a slight tick up, but it was an up day versus down day, and et cetera, et cetera. So it doesn't always work because what indicator works every single time, but I think it's a good one to look at. And the time you're going to look for the spikes are on those climactic days, those days when we have a large decline or a large price rise. All right. Let's look at new highs versus new lows. And this is also considered breadth, a measurement of breadth or a breadth indicator. It's market data, and you base it on the number of issues that have reached 52-week highs or lows. So I think you've seen these percent of stocks, above or below their 52-week highs or lows. I like to plot it with a 10-day moving average of those values, and I'm going to show you that as well. The new high, new low index is basically the number of new highs minus the number of new lows. So it's basically the same as an advanced declines, only you're using new highs and new lows. Oops, I'm going to come back here. So you can use that percent of stocks analysis, review within an index the number of stocks above the various EMAs. You can also use it with the percent of stocks on buy signals. For example, I have a PMO one that I use for percent of stocks. So let's go ahead and take a quick peek. at some of those. So let's see, the best one here, stocks above there. Let's see, new highs, new lows. That's the one I need. All right. So this is a look at, this chart's kind of blurry. Let me see if I can get it to be a little clearer here for you. There you are. I apologize that not all of these are completely set up in the right format here, but there are a lot of charts. I just didn't have time to move them. All right, so here is the price composite, and this is your common stock new highs on the top and the new lows on the bottom. And what you do is, as you can see, I've marked these where you're looking for climactic moves. That can be an indication of a buying initiation or a buying exhaustion. It can be a selling initiation or a selling exhaustion based on what's been happening previously. So those are the values you're really looking for as far as that. And I think this has that 10-day. Yes, the high-low differential. This is one of my favorite indicators. And admittedly, I haven't looked at it very much lately, but I love it because the tops and bottoms on this indicator tend to really line up with tops and bottoms in the market. And so here you go. So let's look at a few here. There's a top that we had back in December, and that tells you that we are overbought. So you would expect a move downward. That came, you can see it's kind of fat, but it came in right before that move upward. The 10-day, let's see, let's go back to, we're looking at tops here. And again, see, when we get these tops, you're not going to actually get a decline every time. Again, no indicator is perfect, but you'll notice we did get some declines, or we got some consolidation. You're looking at whether you're getting these pops on, good volume. Are you getting it on a good price move day? You're making those comparisons. So I like to use the histograms in conjunction with the high-low differential. And this chart is available in the DP Market Indicators chart pack, and I'm going to show you at the end how to download those. So I was discussing using breadth climactic moves. So you're looking at the thrust of those moves, and how the data will tell you if you're going to get a reversal or probably a continuation. I think most of you, if you watch the show regularly or you read the Decision Point blog, you'll know that I use my climactic indicators use breadth. So I'm going to go ahead and show you that. And this particular chart you will find in the Decision Point live chart list. The link is at the top of the Decision Point blog. So you can get right to this chart list. So you can see I have the arrows here. What I'm looking for are these spikes in breadth. So these are the net minus advanced declines. So if you're going to have a day where your net is, you're going to have a lot of advances and you get that spike, that's when I want to go look at the VIX, because I like to compare it. I like to use the VIX. It's a sentiment indicator. We all know that. We use it for sentiment. In the very short term, I find it to be contrarian a lot of times. It gives us some insight when we get breadth readings that are climactic. They give me an indication, like the trend, as to whether we're going to see rally pop. Are we looking at a selling exhaustion, etc.? So, for example, I had pointed out, let's look at this particular reading up here, and I'm going to go into annotate because I want you to see it a little more closely. All right, so we're looking at this climactic reading of the day we had back here last week. And what you'll notice, and you can see this in the thumbnail as well, we look here, there is that big spike, and look what it was accompanied by. It was accompanied by a drop in the VIX to the bottom of its Bollinger Band. Now this is an inverted VIX scale, because like I said, I'm using this as a sentiment indicator, and that's contrarian. So for me, when you see very high readings, On the VIX, you're going to see in the next day or two, you're probably going to see a rally pop. This means that everybody's starting to get very bearish in the short term. So what does that mean as far as sentiment? That means that it's very bullish in the short term. And so when you match that with a pop on these indicators, your expectation should certainly be a rally over the next day or two. That's pretty much what you're looking for. And there you go. So that's one of the ways I like to use breadth indicators using thrust. All right, so there you go. I use breadth in comparison to the Bollinger Band range. All right, so what are some of the takeaways today? I'm going to give you some takeaways, and then we're going to go and learn how to download those chart packs. First of all, breadth is a measurement of internal strength, and it's all based on advancing issues or advancing volume versus declining issues or declining volume, or the number of stocks above or below an EMA, the number of stocks that are on buy signals versus sell signals. Those are all measurements of breadth. We're talking about mainly the number of issues or stocks that are doing one thing or another. We're not really looking at what their price in particular is. We're just looking at whether they're going up or going down, and looking at how many stocks in a particular index are going up, going down, or above, you know, an average or below. So that's the important thing to understand what breadth is. And like I said, you can use it to measure percent of stocks as well, new highs or new lows. It's like I said, with breadth, you're looking at the number of stocks, the number of something. You're not looking in particular at the price values or the momentum values of the MACD, etc. You're counting. It's more of a counting thing. And, you know, typically when we do it, we're looking for divergences or thrust. So in the case of lines, that's where you go and you start looking for the divergences. And when you're in the histogram format, thrust is a great way to look at the analysis there. So now that you're all prepared and you know all about these indicators, let's go and look very quickly at how you can download some of these chart packs so that you'll get the ready-made information. So first of all, you're going to go to your account. This is our Market Watchers Live. Currently, I don't have any chart packs, so this will be helpful for you. Manage chart packs, and then these are all of the ones that we have. These are free. And the one I used first when I was showing those net advanced decline lines, that came from the StockCharts Essentials chart pack. And here you are. So this is what gives you those basic chart lists, and you get all of these. And again, this is for free, and it really does help you organize your charts. So very easy. Install it. And then I'm going to install that framework because it helps as well. So now we come and look at our chart lists. You can see that we have all of the other ones. We have the indicator chart list, and there's your essential breadth indicators. And there's that listing, and that's how you can get to the trend. That's how you can get to the advanced decline lines for not only the S&P, but and the NYSE. You can get the NASDAQ. But if you want to get a little bit more adventurous and get a little bit more as far as the various indicators, I recommend that you get the Decision Point Market Indicators chart pack. I'm going to remove this, and this is how easy it is to get rid of a chart pack you don't want. Manage your chart packs, remove. And I'm going to go back, and we'll go ahead and get the Decision Point Market Indicators. Again, these are free, and they're already done for you. Look, we have all of these these are chart lists, and you can see in each list for the ARMS index, there's 7, and we can give you the information for not just the S&P or the NYSE in those chart lists. You will get the trend, you're going to get the trend not only for the NYSE, but there's the NASDAQ. If we go back and we look at the advanced declines, in summary, you can have the 100, 500, all of these are available, 400, 600. And finally, let's look at, I wanted to show you the McClellan oscillator because we also have that for the various indexes for you. And so I am going to complete my introduction to market and breadth indicators. I hope I was helpful on explaining what breadth actually is. I think we could look at the poll if there's any opportunity to. But what I can, just what I'm seeing in that poll, there we go. People use it sometimes, and I have to say I'm pretty much in that same boat because I use it, but I only look at it typically about once a month, maybe every week if I'm seeing something interesting. Although I do look at that ultra short-term indicator chart all the time, and that does have that histogram of the net advances and declines. So in a way, maybe I should say yes, that I study market breadth in a lot. And then, of course, there's some people that just don't use that. And I hope that 8% that's out there, that number will get smaller after having seen my presentation on market breadth.
Yeah, that was an excellent presentation, Erin. And I would say I'm probably in the sometimes category, and I don't really do much of it myself, but when one of the other commentators here at Stock Charts writes an article about it, I know that Arthur writes quite a bit about the market breadth. And so normally if I see something like that, I'll read through it just to kind of get an idea on what some of the others at Stock Charts are looking at in terms of the breadth and whether or not they feel like, a move to the upside or downside is sustainable, that sort of thing. But I don't really have my own go-to. I thought that was a great reveal there by going in and showing folks how they can download those chart packs to get this information so they don't have to create it themselves, and it is free. So
absolutely,
no reason not to.
Yep. And of course I'm partial to the decision point chart packs, mainly because they give you even more of the indicators. And I think that by going in and having them separated out by the indicator as well makes it very helpful. So
yes, it does indeed.
All right, it's 10 and 10 time, and I'm not going to be showing an RRG because I'm still going to be adding a few here on the end. But I would like to say go in and like other people's symbol requests that are in the chat room. The chat room's to the right of your viewing player if you are watching this live from the StockCharts TV tab. So I will start taking those, and yes, like your favorite, the most popular will be the second symbol that Tom looks at, but our first one is DHR.
Yeah, Danaher's got a great long-term track record. Short-term, it's up against resistance, or it's pretty close to resistance, so I'm not sure I'd pull the trigger on this one from a buy perspective at this point. It's been up right to this 103, 104 area on multiple occasions in 2018, and we have yet to see a close above 104. So I think as we move up, today's high at 102.70, I think we're in the upper end of its current trading range. Looks like maybe a little bit of a rising trend line here with equal highs coming across. I like the pattern. I think eventually we're going to get a breakout here on Danaher, and it's certainly outperforming the S&P 500 as it's getting closer and closer to that January high. The S&P is still quite a bit below it. So I think it's a good stock. I just don't think I would be ready to pull the trigger here until we get the breakout, see some volume come in to confirm that.
All right. And let's see, what is the most popular symbol in the chat room? It would be Red Hat, RHT.
All right, well, it's in a good space. Love the software group. In fact, let's go ahead and pull this one up on a relative chart. Give everybody a look at that. And I do get the question, how do you set this up? So I'm just going to pull up the bottom of the screen here. You can see the parameters set down here at the bottom. It is the price I have set is the dollar industry. So that gives me the industry that the stock falls in. If I type in the industry, in other words, the industry, which is software, if I were to type this in, $DJUSSW, and then I pull up the next chart, and it's not in the software space, then I'm going to show, let's say I pull up McDonald's. McDonald's will show up here. Software will still stay here because I've specifically identified software. So by putting in dollar industry, no matter what industry that particular stock is that you're looking at, it's going to bring up the industry, of its peers, that company's peers. So by doing dollar industry, it'll change with every stock that you pull up. Then I do price dollar symbol colon dollar industry. So that gives me the relative strength of the stock I'm looking at relative to its peers. Then I do the dollar symbol colon dollar SPX, so that the stock I'm looking at, I can compare to the S&P 500. And then finally, I do dollar industry colon dollar SPX, so that this is telling me how well the industry group is doing relative to the S&P 500. So as I pull up the chart up here, you can see here's Red Hat, here's the software industry. That's where Red Hat falls. Then I've got Red Hat relative to the software stocks. Then I've got Red Hat relative to the S&P 500, and I've got software relative to the S&P 500. And one thing you notice here, and I think this is a really important thing to note, you're going to outperform the S&P 500 when you trade stocks that are uptrending, that are in a group that is uptrending, that is uptrending relative to the its peers, and also a stock that is uptrending relative to the S&P 500, and then finally the peer group outperforming relative to the S&P 500. This is a winning formula for beating the stock market. So Red Hat, I don't really have anything bad to say. I think we're in a cup. I could annotate that, but off of this uptrend, it looks to me like we have a nice rounded cup. Probably see some hesitation around 173, 174 as we approach the high from the second week of May. But I would look for a pullback, maybe to hit that 20-day moving average, and then ultimately get a breakout. I think Red Hat still looks very good.
All right, let's see. In that same space, Checkpoint software.
All right, let's see how this one lines up. Well, we know how it's CHKP, right?
Yes, I'm sorry, CHKP.
Right. Yeah, this one now, this is a big difference, because if you're looking at two software stocks, they're not all equal. And when you look at Checkpoint software, we just saw Red Hat, which has been trending higher, but look what this stock is doing. Not really doing a whole lot. In fact, it just recently gapped down on very heavy volume below these prior lows. Maybe this will turn out to be an exhaustion gap off of the selling. But when you look at Checkpoint, it's in a great space, but it is not a good performer relative to its peers. So if you want a software stock, this is not the one you want. You're in a great space, and yet the stock can't outperform the S&P. In fact, it's lagging the S&P 500, even though its group is wildly outperforming the S&P 500. So you don't really want a stock that is a relative laggard. You want a stock that's a relative leader. This is what we've had so many guests come on talk about, relative strength, and it really does make a huge difference. So I think there are a couple things maybe on this chart to keep an eye on. Obviously, after a big gap down back in November on the heaviest volume on the chart, we have not been able to get back up above about 107.50, 108. So I'd watch that level if we ever get back up there. But I think in the meantime, we've got some gap resistance here around 103 from this gap down that we have yet to even fill. So there's a lot of work to be done here on Checkpoint. I'm not a fan. If I was going to get a software stock, I'd be looking more at Microsoft or Red Hat, to be honest.
Okay. Let's go ahead and look at an ETF, Global Robotics and AI, BOTZ, BOTZ.
I don't need the relative chart for this one. Let's take a look at BOTZ. Yeah, the problem with this is that it's just been in this steady downtrend. I mean, eventually we'll probably break out of it, but for now, I'm trying to trade based on momentum to the upside. We've got pretty good support coming in at about 22.85 or so. Maybe even if we go down to that tail at the bottom, maybe 22.70. But this is a key area that I'd be watching in terms of support. Resistance, I think for me, just quickly looking at this, seems to me like we've got a trend line that comes in somewhere around here that we could draw. After the gap down, we have not been able to get back through this 25.25 level. So this is the trading range for now. I'm bullish the overall market, so my gut feeling is that this one will rise and move back toward the 25.25 area. But I'd like to see it maybe clear that declining trend line first, or Probably the best reward to risk would be down close to this support area. If it gets back down below 23, because you can keep a really tight stop.
Okay. The next one is Fred's, broadline retailer, and the symbol is Fred.
I wonder how they came up with that ticker symbol.
I know.
Shocking. Positive divergence, first thing I see, and it looks like it's trying to go through the 20-day. I would not be surprised if it makes it this time. The positive divergence, and Erin touched on this a little bit in her webinar workshop, but when you get lower prices and you've got a momentum oscillator that is turning higher, that gives you a pretty good indication that momentum is slowing to the downside. Now, this particular day, we had heavy volume and we did close at a new low, but we also left a tail and printed a hammer. And I think that's what I would be kind of banking on here, that we're going to go through the 20-day moving average. Now, there is going to be one price resistance level to watch, which is going to be at about 186 or so. And then, and even maybe on an intraday basis, up closer to 2. And the declining 20-day moving, declining 50-day moving average is going to be something to watch, because when you get these positive divergences, if it does play out the way many do, we'll get a 50-day test and we'll get the PPO close to the center line, and then could be that we turn right back down, because we do have an overall downtrend here in play. So short term, if we can get through the 20, I think this one's got some room to run, but longer term, I think we're still in a downtrend. So if I was going to trade it on the long side, it would be simply because of this positive divergence. And if we close back below about 138, 140, that would make me really nervous here.
All right. Next one I have for you. You were talking about banking on something. How about Citigroup? C.
I see where you went with that one.
Well, I actually had already picked it out. I just thought that was funny.
Yeah, I'm going to look at it from a longer term perspective. This one is not performing particularly well. And on a relative basis, you can see it is trying to break below prior lows, whereas the bank index has not. In fact, I think what I'll do is maybe go back to that relative chart and see what Citigroup, what it's telling us here. Yeah, the bank index topped back at the end of January and has been working its way lower, but we've got all these equal lows. And here you can see we got actually slightly declining lows. In the last one where we set the new low, we have big volume coming in. So as a result, you can see that Citigroup, relative to the banks, has actually been outperforming for several months. So this is not what you want to see. It's going back over the course of the last year or so. It is at its lowest level relative to the bank group. It's at its lowest level relative to the S&P 500. And banks have not been performing the way I expected them to. I still give them some hope to move higher, but I don't know that Citigroup would be the one that I would be looking at in this space. I think some of the smaller banks, small to mid-sized banks, are actually performing better than many of these larger counterparts. So I would probably be looking at the 50-day. I'm going to annotate this, but I think the 50-day and the 20-day have been providing some pretty good resistance of late. We did make an initial attempt here to get back through the 50, but we couldn't get through price resistance and then turn back down. But look at the 50-day moving average holding on each of these two prior highs in March and April. So if we do get a pop, I would be looking at that area as one level that we're going to need to clear. And to the downside, I think it's really clear after we went down on some very heavy volume right here, almost 40 million shares, we don't want to lose this level. And we probably, based on some of the prior lows, could step it down a little bit. I'm going to say this 64.5 to 66 area really needs to hold on Citigroup as support.
Okay. The next one for our Canadian friends. Let's go ahead and look at ATD/B.TO.
All right. Is that Aliment?
Food store, consumer staples, yes.
Okay. Definitely under pressure, has been for a while. It's nice to see you. I don't need the, let's do this again up here. Don't really need that relative chart. That didn't help out any. We've got some overhead price resistance that's certainly going to be worth watching. We did move above some key moving averages for the first time in a while. But you can see right at about 57.5 to 57.75, we've had a couple rallies fail. So we are now, seems to be bouncing off the 20. The 20 is trying to cross over the 50. I think things are beginning to turn. but we're going to have a test coming up here to 57 3/4 or so. I would be watching that level very closely. If we do get through, we got another major test up near 60. Look at the volume that came in on this gap down as we continued to sell off from March, was it 20th through the 26th? A lot of big volume selling from 60 all the way down to 55 or so. So if we get through 57 3/4, I think we'll probably make a quick trip to 60, and then we're going to find out what this advance is all about.
All right. The next one, let's do IRDM. And I believe that was a biotech. Yes. Oh, no, mobile telecom. I'm sorry, I was way off on that one. Iridium.
All right, IRDM. All right. Yeah, love the move to the upside, heavy volume. I do think after we saw a lot of sellers coming in, about 17.5, if we continue moving up, I would not be surprised to see sellers show up again in the mid 17s. So as a short-term trader, if I was on this one on the long side, I would probably be selling into the strength as we get close to that level, because that was a lot of volume. It was over 8 million shares that day when it backed off of that 1760, 1770 level and fell all the way back to 16. Now we're making the push back up near there on some much lighter volume. So I just have a feeling that we will see some resistance coming in at that level. So as you get closer, I'd be looking for perhaps a pullback. And I know it seems very unlikely at this point, but I wouldn't be shocked if something came out, maybe a downgrade or something, and we got a quick pullback. But that rising 20-day moving average, I think, is going to be very interesting, as well as the more recent low right here off of the big selling. We had some volume really start to pick up on this candle where we went up to 15, and that was the reaction low back here at about 1460. So I'm going to say for now, my trading range would be maybe 1460 to 1760. Closer I get to that 1760 level, sell. As you pull back close to the 1450, you're going to have the 20-day coming up from underneath as well. I think that would provide some pretty good support.
All right. Next one for you is going to be NUE, and that would be Nucor Steel.
Okay. Well, we're having a lot of trouble getting through 66. If we can do it and get some volume coming in, then perhaps we could make a move for a more substantial resistance area, which is up between 69 and 70. But these tails are bothering me, getting up above 66 and not holding. So if we finish near the low of the day, I'd be a little concerned in the near term.
Okay. And the final one, let's see, AES, and that is AES Corp, utility company.
Well, it's doing pretty well relative to utilities for sure. I don't like today's candle, and there is a negative divergence in play. So that combination right now probably have me out of the stock, especially if it doesn't change by the end of the day. You can see there the higher price. We have been rising on the PPO, but we are still below that prior high, and that is the reversing candle. We shot up at the open, traded up. We got like an inverted hammer or shooting star candle here. Looks to me like this one could be putting in a fairly significant top. And if that is the case, I wouldn't be surprised to see a move back down, maybe as low as 1175 to go back and test these prior lows.
All right, that concludes the 10 and 10. And you will find all of those symbols that are listed right there in the Market Watchers Live chart list. You're going to find the Market Watchers Live chart list right there at the top of the Market Watchers Live blog. Just go to the blogs page and look for our Market Watchers Live blog. You'll find our recaps there as well as the 10 and 10 symbols. Let's go ahead, and I'd like to talk to everybody about something that is coming up in August. And that would be ChartCon 2018. So yes, it's coming August 10th and 11th. And guess what? That's just 2 months away, Tom. You and I will be joining some of the industry's leading chartists, and we're going to bring you 2 full days of expert investing education. So I just wanted to remind everybody that you should register now. It is only $249, and you're going to get full online access to all of the ChartCon presentations anytime. So once you can go there live, or you can keep those presentations and watch them later, or watch them over and over. If you want to participate in live questions and answers with our speakers, we are going to have an opportunity to do that as well. So just because you're watching it from your home or office does not mean that you can't participate in the festivities. It's only $249, so it really is an event you can't afford to miss out on. So recommend you go to stockcharts.com/chartcon, and that's where you'll get all of this information, as well as the link to register. All right, let's go ahead and I will give you our final market update, and then we'll move into turning point. And I am going to make sure this is updated. Okay. So what's been going on with the markets so far? First of all, let's look at the major industries indexes. We have the Dow is down and lower. Mostly, we opened up on the S&P. Notice that big move to the upside, but we have pulled way back and have set some intraday lows. It looks like we're going to come off of those and maybe make it back into positive territory. However, the NASDAQ and the mid caps are both doing well. The NASDAQ has really stayed above that zero line. It's stayed positive pretty much all day long, and is now, it had bounced off of yesterday's close and it's now heading higher. You can see the mid caps spent a little bit of time below yesterday's close, but now have risen and are, looks like, forming maybe a little tiny flag. Russell 2000 looking very much like the NASDAQ. Spending the majority of its time in positive territory. We're actually seeing a bit of a rally right now to get prices back up to all-time highs for the Russell 2000. TSX, Toronto, we're seeing really a symmetrical triangle here, but we got the big boost in the morning, and then the pullback that you can see coincided very well with what we saw in our US markets, but never made it to the negative side and is now consolidating sideways. Treasury yields are lower. We're looking at readings now almost below 2.9%. We're at 2.91% right now for Treasury yields. UUP started the day off nicely, but is now pulled back and is trading near intraday lows at 24.72. Can see that commodities and oil are on the positive side. They did pull back, but we're seeing a nice rally, price trend moving higher for both gold and, for both USO and the commodities. Gold has been on a tear today, and a lot of people would have probably been interested in the fact that we had noticed that big rally off of yesterday's close for the dollar. And we were also seeing the same sort of action from gold. We're seeing an upside move. So as I had been talking about before, the correlation, that reverse correlation, negative correlation between the dollar and gold has started to change a bit in its characteristics. It's getting lower. So this means that just because the dollar goes up 0.5% does not mean that gold is just going to go exactly down 0.5%. We're starting to see gold decouple from the dollar, and so that, I think, was quite noticeable near the open and into the morning, where you could see both gold and the dollar were rising at the same time. The VIX is hovering right around 13, currently reading at 12.92. And I'm going to conclude the final market update. I do want to show you one chart, and that would be the Dow. Yesterday, I did get a new short-term trend model buy signal for the Dow Industrials. You can see how the 5-day EMA popped above that 20-day EMA. And additionally, yesterday we found a PMO buy signal. So we had just gotten that sell, and then we whipsawed back up. I discussed this yesterday in the decision point report. I was expecting this, and now we've seen it. I'm going to be watching it closely now. I noticed in the thumbnail there was a little bit of concern for me in that you could see that OBV. We have those bottoms that are moving lower with price bottoms moving up. I thought that was an interesting divergence, so we'll have to see. All right, and that concludes the final market update, and I will pass it back to you, Tom, so you can explain what's going to happen in this final segment. I'm going to take a break, and if you have any questions about market breadth and the presentation I did, feel free to throw those questions in the chat room, and I'll go ahead and start answering some of those.
Okay, sounds good. Appreciate the update. Does look like the market trying to rally back a little bit, and we are seeing the Nasdaq and the Russell 2000 in positive territory again, which is what we've been experiencing mostly for the past couple of months. A little bit of outperformance there, especially on the Russell 2000. But let's go ahead and get into Turning Point. This is a fairly new segment. I think we've done this one once or twice, but really what we're doing with Turning Point is looking for critical junctures on a chart from a technical perspective. And I think if you can find these points before they actually hit, then I think you can maybe adjust your trading strategy accordingly. The first chart I wanted to pull up here is the dollar index, or the dollar bullish fund, the UUP, because you look at this chart and it looks like, okay, well, it's been rising. It's, maybe just pulling back a little bit. But this 25 area was a pretty critical area of support. So I'm going to go back and just show the last couple of years, or excuse me, area of resistance. But I'm going to go back over the last couple of years, and you can see that the breakdown here at about the 20, it was just under $25. And then when we came back up, we got to about 24.75. So we really have a couple of tops here that I think are fairly significant. I believe the dollar is going to continue to go higher, but I'm not surprised that we're getting a pullback at this particular level. So getting back up to that 24.75 area here, and then back to test this breakdown level, which was just below 25, and then turning back over. I think that was a critical turning point in the near term on the dollar. Now, whether or not that continues to hold as major resistance remains to be seen. I don't believe it will. I think, if anything, maybe we get a pullback, a test of this rising 20-day moving average, but just about everything I'm looking to points to a much higher dollar in 2018. And so I think we're going to go back through that 25 area. But at least in the near term, from a short-term trading perspective, it is important to note those kinds of turns or potential turns. Let's talk about the NASDAQ, because the NASDAQ making its way back up over 7,600. That is big news. And so the question is this going to continue? Well, look at where we were back in March. Now, we might just go right through this resistance level, but as we think about turning points, sometimes we see them on the charts. Other times we look and maybe try to anticipate. I think this is a pretty key area, because back on March 13th, we opened at 76.2752. That was our high candle body, and that marked a pretty significant turning point then. We put in a bearish engulfing candle and did so with the heaviest volume that we had seen, or among the heaviest volume we had seen in a month. So that was a pretty significant reversal. We ended up going all the way back down to test the prior low, and now we've worked our way all the way back up. But if you look at where we are now, again, that 76.27 level right here was that candle body. And so we've got the NASDAQ making a really nice move up here. But the question is, with today's open at 76.21, are we going to close above 76.27 today? We got up as high as 76.44. So intraday, we made that breakout. That also topped the intraday move back on March 13th. But so far, we are not confirming it. Sitting right now at 76.26 and change. So I think the next few hours are going to tell us something about the NASDAQ. Now, if we fail to make the breakout today, I think we do still have a very strong PPO. I think the long-term chart's bullish. So if we fail and we pull back, I expect it to be a temporary pullback, but it wouldn't be a shocker to see us go back and test the rising 20-day moving average if we do fail at the close today. So something to keep in mind, because if the NASDAQ turns, if this is truly a turning point on the NASDAQ chart, obviously there are going to be a lot of component stocks that are going to struggle in the short term as well. All right, let's go through a few more of these. I've got a number of them. But within the NASDAQ, of course, one key area would be the internet stocks. So if I pull up the DJUSNS and take a look at this, I think you'll see pretty clearly that we have some serious resistance, overhead resistance, at about 1765 to 1770. We got up 1769 today. We've been up, last 4 or 5 days, we've made a huge move higher in internet. Question is this a turning point? We won't know until the close, but if you see us really weaken into the close and close back down on the lows, I would begin to assume that in the very near term, we have hit resistance and are more likely than not going to pull back. A move back down to around 1700 would be interesting on the internet stocks. All right, let's take a look at the semiconductors. Another key area within technology and in the for the NASDAQ in particular. Very similar to what we were looking at on the NASDAQ, though, where we had that high in March that we're trying to negotiate. That was the candle body high. We have cleared that, but we do still have this intraday high up here that we are just in the midst of. So this 3,700 to 3,750 area on semiconductors looks like it could be a turning point. So we want to keep an eye. Again, we see a big reversal somewhere in this neighborhood. Doesn't have to be today. Maybe it's tomorrow. Maybe it's later in the week. But this is an area where we could see a turning point develop. And like the NASDAQ and like internet, I do like the PPO here. So I think even if it does reverse, it would probably be an area to take some short-term profits and maybe re-enter on weakness. Maybe if we were to drop about 3 or 4% on the semiconductors over a short period of time, it could set up some very nice opportunities in that space. Let's move on to some individual stocks. Merck, MRK. Merck clearly is at a potential turning point, something to watch. When I was looking earlier, this candle looked much more bearish. We were down closer to the low, had a bearish engulfing candle. And when you look at a stock like this, it's up against resistance, just barely makes the breakout. I did like the volume coming in yesterday to clear that prior candle body high. So that was a good thing, but a reversing candle would not have been good. So we want to see how this closes. If we get back up near the high of the day, I think we're going to make a run for that intraday high, 63 and change, see if we can clear that. UNH. This is one that I talked about recently, that it typically performs well in May. And it had a really strong May. At least the middle part moved up, went, kind of consolidated. I think still looks good, holding that 20-day moving average. But it was clear when we moved up and hit this resistance level right here, couldn't get through the candle body high, put in a reversing dark cloud cover candle, and that led to some temporary weakness back to the 20. So when I talk about the semis and the internet's maybe pulling back temporarily, this is what I'm talking about. We saw it with UNH just a couple of weeks ago, got up to resistance, tested it, failed, pulled back at the 20, and now we're still in a bullish pattern that I think eventually we're going to break out of. Next up is JD.com, ticker symbol JD. JD, things look pretty good here on the daily chart. I think most would have to admit we're close to the May 7th high. We're at gap resistance. We've gotten through both moving averages. The volume's picking up. What could possibly be wrong? Well, JD has been under pressure for quite some time, and notice that the move to the upside here, getting close to 40, is testing this declining 20-week moving average. So the long-term chart says be really careful here with JD. I think 36 is a critical area of support, and I think right around 40 is your key area of resistance. Let's see which one gives first. I think we're at a key turning point potentially on JD. ABT, Abbott Labs. Abbott Labs moving up. I don't have to annotate, but you can see a couple of tops here coming in 63.5. We traded today as high as 63.29. Abbott Labs getting close to a potential turning point. ZTS. Most of these stocks, by the way, I've gotten out of the S&P 500. ZTS, I think it's pretty clear. 85, 86 has been a key area where we have turned in the recent past. We gapped down on very heavy volume in early May. We've made our way all the way back up into this 85, 86 range. Could be a turning point. ADS, Alliance Data Systems. Well, I think looking across here, we broke down on very heavy volume in late March below the 215 level. Look at the reaction highs here. And again here, this could be a bottoming head and shoulder pattern. Left shoulder, neckline, head, neckline, right shoulder. And now we're trying to move up. We need more volume and we need to clear 215. Otherwise, could be a turning point. ADSK, Autodesk, clearly a couple of tops, maybe more than a couple tops, maybe 5 or 6 tops up near this 140 level. Got key support, gap support down at 120. This is a trading range. We're making our move back up. Today's earlier high 138. Watch it at 140, could be a turning point. AFL. Aflac, I think, looks pretty solid. And to me, just a matter of time before we get the breakout. But we haven't gotten it yet. You can see multiple tests up here, 45.75 to 46 without being able to push through. Watch the volume down here. If we can clear 46 with increasing volume, I think that would be a very bullish turning point for Aflac. And just maybe 2 more here. GD, General Dynamics. I think this is a key area of support. The defense stocks had been doing just horribly to end April and to start May. We bounced back up. The one reaction low here was around 200. We are trying to bounce off of 200 here. I think this could be a turning point on GD. And the last one I have is IRM, Iron Mountain. Once again, pretty obvious. Breakdown on increasing volume back on January 29th below about 34.60. And look at all of the moves back up to about 34.60. We can't get through. Yesterday, we closed at 34.57. Today, we might be putting in a reversing candle. This could be a turning point. So to summarize, let's pull up a slide. You can take a look at the charts that I just went over. But it really doesn't matter whether you're looking at daily charts, weekly charts, hourly charts. I like to follow these candlesticks because I do think the candlesticks can identify significant turning points for us. I don't know if those are going to be turning points that I mentioned, but those are levels to really watch because they have been turning points in the past, and history does tend to repeat itself in the stock market. Okay, well, that is it for today. Erin, I know we got a few more days left in the week, but so far not too bad this week.
Yeah, I was, we had that nice rally yesterday. I was feeling pretty good. And today, really volatile. Makes everybody a little bit nervous. That's probably why we're seeing that VIX moving where it has been. But I'm looking forward to this week because, I did talk about breadth earlier in the program, and one of my reference books was Charles Kirkpatrick's book on technical analysis, the complete resource for financial market technicians.
Well, I do know, in looking, at the market, I know the Dow and the S&P have really struggled on a relative basis, but the rising dollar has definitely put a nice bid under the Russell 2000. We've seen more than a 10% move in the Russell in the past 2 months, while the Dow Jones during that same time period is up maybe about 3%. So,
well, I'm glad we've been tooting the horn of technology, but I know yesterday we were talking about, that's the place to look for some momentum. And, today the NASDAQ is, trading in positive territory, whereas, the Dow and the S&P 500 are struggling.
Yep. All right. Well, this wraps it up. I guess we got, you can take a look there at the schedule coming up.
Yes. So we have Charlie Kirkpatrick Wednesday. Thursday is going to be Mr. Wyckoff. Everybody loves it when Bruce Fraser joins us. And everything stock charts. I heard Chip Anderson is going to join us, Tom.
That will be exciting. Always nice to hear from the Prez. If you want to find out what's going on in stock charts, I can't think of a better person to have on here. But I do want to thank everybody for joining us today. Certainly a pleasure having you. Please remember to complete the survey as you exit. We'd like to know what you thought of today's presentation, especially Erin's workshop. I'm sure she'd love to get some feedback on that. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everyone. Hope to see you back here on Wednesday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.